This is the second in a series of residential development and investment podcasts from myself, Matt Bowen, and Oliver Knight from Knight Frank's residential research team. This week, we have split the update into three sections: the economy, the housing market and our forecast, and development.
So let's start by looking at the economy. It's fair to say that the outlook remains uncertain, with most economic forecasters torn on a number of factors, including the length of the lockdown, the depth of the recession in Q2 this year, and also the speed of the recovery. These are the latest numbers from Oxford Economics, who are assuming a 2-month lockdown. They're forecasting a 5.1% drop in GDP in 2020, followed by a fairly swift bounce back in 2021, with growth of around 6%. This recovery is expected to be driven by low inflation, as well as loose fiscal and monetary policy, which should provide a notable boost to household spending power over the coming 18 months.
Unemployment is obviously a key indicator to watch for in the housing market. And like the economy, this is expected to take a hit this year, despite that unprecedented government support. To put some numbers behind that, Oxford Economics is expecting unemployment will spike at the end of this year at 6% before returning to current low levels by the mid-2020s. For context, unemployment peaked at 8.5% in the UK following the financial crisis. Elsewhere, interest rates, important to the housing market, are expected to remain at their current low level of 0.1% for longer before gradually picking up, pointing to the continuation of this lower for longer environment, which has really underpinned property markets into the early 2020s.
With this in mind, what does it mean for the UK housing market? Well, it's true that if you look back over the last few decades, wherever there has been an economic downturn, this has also coincided with a downturn in the housing market. But it is worth noting that the circumstances surrounding this dip are very different to previous downturns, not least because of the health of the property market at the turn of the year, when there were real signs of a resurgence across the UK, boosted by that clarity that we saw around Brexit and also the Conservative election win in December. New buyer registrations and also exchanges both picked up notably.
Data released last week from Molior showed the same was true in the new homes market, with the first quarter of 2020 second best quarter in terms of new build sales in London than at any point since 2015. Figures from the Bank of England, meanwhile, show that new mortgage lending hit a 6-year high in February, the month before the coronavirus outbreak in the UK. All of this points to a market which was in pretty good shape before mid-March.
However, since then, this recovery has effectively been put on hold. Deals are still taking place, but there's undoubtedly been a sharp drop in demand over the past few weeks, largely tied to the government restrictions on movement and also difficulties in lending markets. Of course, the full impact on the market will really depend on the duration that movement restrictions are in place for, but inevitably it will impact on housing delivery and sales this year and probably early next.
Yes, we're currently anticipating that residential transactions across the UK will drop by around 40% overall over the course of the year, but that capital values will be less affected, with falls in the short term, but stronger growth in the medium to long term.
In terms of new development, we know that a number of house builders have halted construction on sites, and that's clearly going to impact on delivery this year, especially when you consider that the latest data from Molior suggests that in London, in the last quarter, it was the slowest start to the year in terms of new housing starts since 2013. Completions, meanwhile, had actually quite a strong start to the year.
There is also some positive news from the planning system, which appears to still be moving. Data from Glenigan suggests that 430 sites received consent for residential development in March across the UK, compared with the February figure of 327. Keeping the cogs turning here will be key to a faster recovery period once the lockdown has passed, and we wouldn't be surprised to see further government support aimed at boosting supply announced at some point.
Now, one section of the market that could be set to benefit from all of this is the residential investment market, particularly if activity is slow to pick up once something approaching normal service resumes. And one reason that we think that is because actually the current volatility that we're seeing in traditional real estate investment markets is likely to act as a bit of a catalyst for investment into what are considered more defensive, non-cyclical, secure, income-producing assets.
Definitely. And if we take student property as an example, this chart here really just reinforces the idea that it's a defensive asset. The relationship between UK economic performance and the desire to study is clear. for example, with student numbers often increasing during times of uncertainty as students look to upskill.
And in fact, data shows that between 2007 and 2010, for example, as we can see on the chart on the left, when UK economic growth contracted by around 4.5%, actually applications to UK universities jumped by around 30%. Now, even though this downturn is expected to be short-lived by comparison, we would expect to see a similar trend given the likelihood of an increasingly competitive jobs market as the recovery takes hold.
Yeah, the investment case for student property also remains compelling, with evidence that total returns for student property have held up against previous drops in real estate activity. Rental growth within the sector, for example, has averaged 4.5% over the last 10 years compared to average RPI inflation of 2.8%, and rental growth in the office and industrial sectors of 1.8% and 1.4% respectively. We expect long-term this will remain the case in spite of any short-term challenges.
Thanks, Matt. So that's a really brief roundup of where we see residential markets at the moment. With the market largely on hold, it's pretty difficult to draw any long-term conclusions, but it's probably fair to assume that actually weaker economic activity in the first half of 2020, the dislocation in the jobs market and also weakened consumer sentiment will have an impact on both pricing and activity in the short term, but that actually the relatively finite time span of the crisis will mean that any declines are limited. As always, please do get in touch with Matt or myself if you had any questions.
Yes, and also if there's anything else you'd like to see covered in future updates, then please let us know. Thanks again and stay well.